September 15th, 2008, Lehman Brothers, a 158-year-old investment bank, files for bankruptcy. Within hours, the stock market loses $700 billion in value. Within weeks, the entire global financial system is on the brink of total collapse. By the time the dust settled, 8 million Americans had lost their jobs, 6 million lost their homes, and $19.2 trillion in household wealth just vanished. But here's what really happened. This wasn't an accident. This wasn't a natural disaster. This was the largest transfer of wealth from the poor and middle class to the ultra-rich in modern history, and it was completely preventable. Welcome back to the channel. Today I'm going to explain exactly how the 2008 financial crisis happened, who was responsible, who got rich while millions suffered, and most importantly, why it's probably going to happen again. By the end of this video, you'll understand more about the financial system than 99% of people, and you'll know exactly how to protect yourself next time. Let's dive in. To understand 2008, we need to go back to the late 1990s and early 2000s. The dot-com bubble burst in 2000, the dot-com bubble burst, tech stocks crashed, the economy went into recession. Then 9/11 happened in 2001, making things even worse. The Fed's response. So the Federal Reserve, led by Alan Greenspan, did what central banks do. They lowered interest rates dramatically. They dropped rates from 6.5% all the way down to 1% by 2003. The idea was simple. Make borrowing cheap so people spend money and revive the economy. It worked too well. Cheap money everywhere. With interest rates at historic lows, everyone could suddenly afford to borrow money. And what did Americans do with all that cheap money? They bought houses. The housing boom begins. From 2000 to 2006, housing prices in the United States nearly doubled. In some cities like Las Vegas, Phoenix, and Miami, they tripled. Everyone believed the same thing. Housing prices always go up. Real estate never goes down. This is the safest investment ever. People who'd never invested before were buying 3, 4, 5 houses as investment properties. House flipping shows were all over TV. Everyone's neighbor was suddenly a real estate mogul, making millions. And banks? Banks were falling over themselves to lend money because they'd figured out something absolutely brilliant, or so they thought. They'd figured out how to make the risk disappear. Okay, here's where things get interesting. Let's talk about subprime mortgages. Traditional lending. Traditionally, if you wanted to buy a house, you'd go to a bank and apply for a mortgage. The bank would check your credit score, verify your income, make sure you could actually afford the payments. If you qualified, they'd lend you the money. And here's the key part. The bank would hold that mortgage. If you stopped paying, the bank lost money. So they had every incentive to make sure you could afford it. The new model. But in the 2000s, banks figured out they didn't have to hold the mortgages anymore. They could sell them to other investors. It's called securitization. Think about it from the bank's perspective. Why would you care if the borrower can pay back the loan if you're just going to sell that loan to someone else next week? You get your money immediately, and the risk belongs to whoever buys it. This created a perverse incentive. Ninja Loans banks started giving out what they called ninja loans. No income, no job, no assets. You could literally walk into a bank with no job, no money, terrible credit, and walk out with a $500,000 mortgage. Some banks didn't even verify the information on applications. You could write down that you made $200,000 a year working at McDonald's, and they'd approve you. Teaser rates. And here's how they sold these garbage loans. Adjustable rate mortgages with teaser rates. Hey, you can't afford a $2,000 monthly payment. No problem. How about we start you at $600 a month for the first 2 years? In tiny print that nobody read. After 2 years, your payment will jump to $12,500 a month. People who could barely afford $600 were signing up for loans that would become $20,500. But they convinced themselves that's fine. The house will be worth so much more in 2 years. I'll just refinance or sell. Who was getting these loans? Everyone. Teachers, waitresses, construction workers, retirees. People were taking out mortgages for $400,000 houses while making $35,000 a year. One woman in California had no job and got approved for 5 mortgages totaling over $2 million. Why would banks do this? Because they weren't keeping the mortgages. They were packaging them up and selling them to Wall Street. And Wall Street had figured out how to turn these toxic loans into pure gold. This is where Wall Street gets creative. And by creative, I mean commits what should be considered financial fraud on a massive scale. Mortgage-backed securities. Investment banks like Goldman Sachs, Morgan Stanley, Bear Stearns, and Lehman Brothers started buying up thousands of these subprime mortgages. They'd take 10,000 mortgages and bundle them together into a single investment product called a mortgage-backed security, MBS. Here's their pitch. Sure, some of these individual mortgages might default, but they won't all default at the same time, right? So statistically, this bundle of mortgages is actually pretty safe. Collateralized debt obligations, CDOs. But they didn't stop there. They took it further with CDOs, collateralized debt obligations. Here's how it worked. They'd take a bundle of these mortgage-backed securities, many of them subprime garbage, and slice them into different tranches or layers. The top layer, AAA rated, gets paid first. The middle layer, BBB rated, gets paid second. The bottom layer, junk, gets paid last. Now here's the magic trick. They'd take the worst tranches, the actual garbage that was rated BBB or lower bundle, those together, slice them up again, and somehow the top layer of this new CDO would get rated AAAA. Let me repeat that. They took the worst, riskiest mortgages, repackaged them, and rating agencies called them as safe as US Treasury bonds. It's like taking a pile of manure, moving it to a different pile, and calling it gold. Synthetic CDOs. But wait, it gets worse. They created synthetic CDOs. These weren't even backed by real mortgages. They were bets on whether other CDOs would fail. It was like making copies of copies of copies. Pure gambling. Michael Lewis, who wrote The Big Short, called them weapons of mass destruction. And they were everywhere. The scale by 2007, the CDO market was worth over $640 billion, and much of it was built on mortgages given to people who could never afford to pay them back. Banks were selling these to everyone. Pension funds, retirement accounts, foreign governments, other banks. They told everyone they were safe. AAA rated, no risk. It was the biggest financial scam in history. And everyone on Wall Street knew it. You might be wondering, how did these toxic assets get RDA ratings? That's where the rating agencies come in. The big three. There are 3 major credit rating agencies: Moody's, Standard & Poor's, and Fitch. Their job is to evaluate investments and rate them based on risk. AAA means super safe. D means default. These ratings matter. Pension funds and institutions are legally required to only invest in highly rated securities. So an A rating opens up trillions in investment dollars. The conflict of interest. Here's the problem. Rating agencies don't get paid by investors. They get paid by the banks issuing the securities. Think about that. The banks creating these CDOs were paying the rating agencies to rate them. If Moody's gave them a bad rating, the bank would just take their business to S&P or Fitch instead. Shopping for ratings, and that's exactly what happened. Banks would shop around for the best rating. They'd literally tell the agencies, we need this to be AAA. How can we structure it to get AAA? The agencies would help them engineer the CDO specifically to get the rating they wanted. Then they'd rate it AOA and collect their fee. The emails. After the crisis, investigators found internal emails from rating agency employees that are absolutely damning. Let's hope we are all wealthy and retired by the time this house of cards falters. It could be structured by cows and we would rate it. These deals could have been structured by cows and we would rate them. They knew these securities were garbage. They rated them a anyway, because that's where the money was. How much money? Moody's stock price increased 400% between 2000 and 2007. Their operating margins were over 50% higher than Apple, higher than Google. They were printing money by lying about the safety of toxic assets. And when everything collapsed, nothing happened to them. No one went to jail. They paid some fines, pennies, compared to what they made, and went back to business as usual. The rating agencies were supposed to be the watchdogs protecting investors. Instead, they were co-conspirators in the heist. While everyone was getting rich, a handful of people saw what was coming, and they bet billions that the housing market would crash. Michael Burry. Michael Burry was a doctor who became a hedge fund manager. He's the guy from The Big Short, played by Christian Bale. In 2005, Burry started looking at the mortgages inside these mortgage-backed securities, and he realized something terrifying. They were garbage. People with no income were getting mortgages they'd never be able to pay back. He calculated that when these adjustable rate mortgages reset to their real rates in 2007-2008, massive defaults would happen. The whole system would collapse. So he did something crazy. He went to big banks and said, I want to bet against the housing market. I want to buy insurance on these mortgage bonds. The banks laughed at him. They thought he was insane. Housing prices never go down. But they were happy to sell him this insurance called credit default swaps because they thought it was free money. Burry invested over $1 billion in these bets. Steve Eisman. Steve Eisman, another hedge fund manager, did the same thing. He went around meeting with mortgage lenders and was shocked by what he saw. He met mortgage brokers who were giving loans to strippers who owned 5 properties. Loan officers who were approving mortgages for $700,000 to people making $14,000 a year. He realized the entire system was fraudulent, so he bet against it too. John Paulson. John Paulson was a hedge fund manager who made the biggest bet of all. He raised $15 billion to bet against subprime mortgages. People thought he was crazy. His investors were nervous, but Paulson saw the math. These mortgages would default, the CDOs would collapse, and whoever was betting against them would make a fortune. The waiting game. But here's the thing. They were right, but they were early. For 2 years, housing prices kept going up. Their bets kept losing money. Investors started pulling out. People called them idiots. Burry was almost fired. His investors sued him to get their money back. But he held on because he knew he was right. The vindication. Starting in 2006, those adjustable rate mortgages started resetting. People couldn't afford the new payments. Defaults started happening. Foreclosures began mounting. By 2007, it was clear something was very wrong. By 2008, it was a full-blown crisis. Michael Burry made $700 million for his investors. Steve Eisman made hundreds of millions. John Paulson made $20 billion. The single greatest trade in financial history. They saw what was coming because they actually looked at the underlying mortgages. Everyone else just trusted the ratings and the hype. And here's the kicker. Even as they were betting against these securities, the banks were still creating more of them, still selling them as safe investments right up until the very end. By early 2008, the cracks were showing, but the real collapse happened in September 2008. 14 days that almost destroyed the entire global financial system. The dominoes start falling. March 2008, Bear Stearns. Bear Stearns, a major investment bank, collapsed and had to be sold to JP Morgan for $2 per share. A year earlier, it was trading at $170. July 2008, IndyMac Bank. IndyMac Bank, one of the largest savings and loans, failed. Lines of people trying to withdraw their money wrapped around blocks. Classic bank run. September 7, 2008, Fannie Mae and Freddie Mac. The government took over Fannie Mae and Freddie Mac, the 2 giant mortgage companies. They guaranteed half of all mortgages in America, $5 trillion worth. September 15, 2008, Lehman Brothers. Then came the big one. Lehman Brothers filed for the largest bankruptcy in US history. $600 billion in assets gone overnight. Employees walked out of the building carrying boxes. 158 years of history erased. 26,000 people lost their jobs immediately. The panic. The stock market went into freefall. The Dow Jones dropped 504 points in a single day. the largest point drop since 9/11. But it wasn't just stocks. Credit markets froze. Banks stopped lending to each other because nobody knew which bank would fail next. If banks won't lend to other banks, the entire system stops working. September 16th, AIG. The next day, AIG, the world's largest insurance company, was on the brink of collapse. They'd sold hundreds of billions in insurance on those CDOs. Now, they were being asked to pay up, and they didn't have the money. The government stepped in with an $85 billion bailout. Eventually, that would grow to $182 billion. The weak from hell companies that had been around for 100+ years were disappearing in days. ATMs might stop working. Your savings might vanish. Your paycheck might not clear. This wasn't just a stock market crash. This was the entire financial system on the edge of complete failure. Treasury, Secretary Hank Paulson. Hank Paulson, the Treasury Secretary and former Goldman Sachs CEO, went to Congress and said, "Give us $700 billion immediately, or there will be no economy on Monday." Not an exaggeration. That's what he actually said. The government started bailing out banks left and right. Billions to Bank of America. Billions to Citigroup. Billions to Goldman Sachs, Morgan Stanley, Wells Fargo. The bailout. On October 3rd, 2008, Congress passed TARP, the Troubled Asset Relief Program, $700 billion in taxpayer money to bail out the banks. But here's the thing. They didn't bail out the people who'd lost their homes. They didn't bail out the retirement accounts that were destroyed. They bailed out the banks that had caused the crisis. The banks that had created the toxic mortgages, packaged them into CDOs, sold them as safe investments, and crashed the global economy, got rewarded. Let's talk about where the bailout money went. Because this is the part that should make you absolutely furious. The top bailout, $700 billion. The official line was, "We need to stabilize the financial system to protect American jobs and savings." The reality, we gave hundreds of billions to the banks that caused the crisis, and they used it to pay themselves bonuses. Bank of America, $40 billion. Bank of America got $45 billion. What did they do with it? In 2009, they paid out $3.3 billion in bonuses, including paying 172 employees more than $1 million each. Citigroup, $45 billion. Citigroup got $45 billion. They paid out $5.3 billion in bonuses in 2008. Then they bought a $50 million private jet. When Congress found out, they were like, "You took taxpayer money and bought a private jet?" Citigroup's response, "Oops, okay, we'll cancel that order." AIG, $182 billion. AIG got $182 billion, the biggest bailout in history. Then they spent $440,000 on a spa retreat for executives, massages, pedicures, golf, a week after getting taxpayer money. When that came out, there was public outrage, congressional hearings, but nothing really changed. Goldman Sachs, $10 billion. Goldman Sachs got $10 billion, then they paid out $4.8 billion in bonuses. Their CEO, Lloyd Blankfein, personally made $68.5 million that year. When asked to defend this, Blankfein said Goldman Sachs was doing God's work. I'm not making that up. That's a real quote. The kicker. Many of these banks paid back the TARP money fairly quickly. And politicians said, "See, the bailout worked. We got our money back." But that ignores all the other ways we bailed them out. The Federal Reserve bought 1,025 trillion dollars in mortgage-backed securities. 0% interest rates for years. Guaranteed their deposits. Let them borrow unlimited money at 0% interest. The total cost of the bailout? Estimates range from $4.6 trillion to over $29 trillion, depending on how you count it. Who didn't get bailed out? The 6 million families who lost their homes to foreclosure. The government program to help struggling homeowners? It was a joke. Only a fraction of people who applied got help. The 8 million people who lost their jobs. The retirement savings that were destroyed. The small businesses that went bankrupt because they couldn't get loans. Main Street suffered. Wall Street got bonuses. Did anyone go to jail? In the savings and loan crisis of the 1980s, which was way smaller, over 1,000 bankers went to prison. After 2008, the biggest financial crime in history. How many top executives went to jail? One. One person. A mid-level Credit Suisse trader. Not a single CEO. Not a single executive from Goldman Sachs, Lehman Brothers, Bear Stearns, Merrill Lynch, Citigroup, Bank of America, AIG. Nobody. They committed fraud on a massive scale, destroyed the global economy, and walked away rich. So where did all that wealth go? $19.2 trillion in household wealth disappeared. It didn't just evaporate. It went somewhere. The Great Transfer. What happened was the largest transfer of wealth from the bottom 99% to the top 1% in modern history. How it worked? Regular people lost their homes. Banks foreclosed on millions of properties. Those properties were then sold at huge discounts to hedge funds and private equity firms. Blackstone, one of the world's largest private equity firms, spent $10 billion buying up foreclosed homes at pennies on the dollar. They turned them into rentals and made billions. Stock market. Regular people panicked and sold their stocks at the bottom. Their 401ks were devastated. People who were about to retire had to keep working for another decade. Meanwhile, wealthy investors bought stocks at rock bottom prices. When the market recovered, they made fortunes. If you had money to invest in 2009-2010, you became very wealthy. If you were living paycheck to paycheck, you got crushed. Wealth concentration from 2009 to 2012, the top 1% recovered all their wealth losses. The bottom 99% recovered none of theirs. Actually, it's worse than that. The top 1% actually gained wealth during the recovery while everyone else was still underwater. The rich got richer. The number of billionaires in the US increased during the crisis. How does that happen? Because if you have capital during a crisis, you can buy assets cheap. If you're a billionaire and the stock market crashes 50%, you buy stocks. When it recovers, you're now a multi-billionaire. If you're a regular person living paycheck to paycheck, you lose your job, drain your savings, sell your stocks at a loss, and fall behind on your mortgage. The new math before 2008. The median household was worth about $135,000. After 2008, the median household was worth about $80,000. That's a loss of over 40% of median wealth, and it took until 2016 to recover to pre-crisis levels. Meanwhile, the top 0.1% saw their wealth grow by 80% from 2008 to 2020. The legacy. The crisis created a generation of young people who graduated into the worst job market since the Great Depression. Millennials entered the workforce during a recession, started careers late, couldn't afford homes, delayed families, and have significantly less wealth than previous generations at the same age. The crisis fundamentally changed the trajectory of millions of lives, and the people who caused it, they're doing just fine. So the big question, could it happen again? The short answer, absolutely yes. What's changed? After the crisis, Congress passed Dodd-Frank, a financial reform bill meant to prevent another crisis. It added some regulations. Higher capital requirements for banks. The Volcker Rule. Limiting risky trading. New oversight for derivatives. Stress tests for big banks. Sounds good, right? What hasn't changed? 1. Banks are bigger. The too big to fail banks are now bigger. Through the crisis, big banks bought failing banks. JP Morgan, Bank of America, Wells Fargo, they're all much larger now. In 2008, the top 5 banks controlled 35% of banking assets. Now they control over 45%. They're even more too big to fail. 2. Regulations are being rolled back. In 2018, Congress weakened Dodd-Frank. They raised the threshold for systemic importance from 50 billion to 250 billion, exempting dozens of large banks from oversight. Banks have spent over $1 billion lobbying to weaken regulations since 2008. 3. New risks. The risks have just moved to new places. Corporate debt is at record levels. Student loan debt is $1.7 trillion. Private equity is now massive and mostly unregulated. Commercial real estate is struggling. Shadow banking, non-bank lenders, is huge. Fact 4. Moral hazard. This is the big one. We showed banks that if they take huge risks and fail, the government will bail them out. But if they succeed, they keep the profits. That's called moral hazard. Why would banks be careful when they know they'll be rescued? 5. Nothing structural changed. The fundamental incentive structures that caused the crisis are still in place. Wall Street traders still get bonuses based on short-term profits. Rating agencies still get paid by the banks they rate. Politicians still get campaign donations from banks. Regulators still come from and return to the industry. Revolving door. Warning signs now. In 2023, we saw bank failures. Silicon Valley Bank, Signature Bank, First Republic. Why? Similar patterns. Concentrated risk, poor oversight, rapid growth. Commercial real estate is in trouble. With remote work, office buildings are half empty. Many are worth far less than the mortgages on them. Sound familiar? Student loans, auto loans, credit card debt, all at record levels. When rates go up, people struggle to pay. The bottom line. We didn't fix the underlying problems. We just papered over them. The same incentives exist. The same players are in charge. And the banks are bigger and more powerful than ever. It's not a question of if another crisis will happen. It's when. So what have we learned? The 2008 financial crisis wasn't an accident. It was the inevitable result of a system designed to enrich the few at the expense of the many. Banks gave out mortgages to anyone with a pulse. Wall Street packaged these garbage loans and sold them as safe investments. Rating agencies stamped them a travail for a fee. Regulators looked the other way. And when it all collapsed, taxpayers bailed out the banks while millions of regular people lost everything. The lessons. 1. The system is rigged. When banks win, they keep the profits. When they lose, taxpayers cover the losses. Privatized gains, socialized losses. 2. Nobody is coming to save you. The government will bail out banks before it bails out you. You need to protect yourself. 3. Wealth inequality is getting worse. Every crisis makes it worse. The rich have capital to deploy when assets are cheap. Regular people just survive. 4. Financial literacy matters. The more you understand how the system works, the better you can protect yourself and build wealth. How to protect yourself? Diversify your investments. Don't put all eggs in one basket. Keep an emergency fund, 6 to 12 months of expenses. Don't take on debt you can't afford, especially adjustable rates. Understand what you're investing in. If you don't understand it, don't buy it. Think long term. Don't panic sell in crashes. Own assets that hold value. Real estate, stocks, gold. Stay informed about economic indicators. The final word. The 2008 crisis showed us the truth. The financial system isn't designed to serve regular people. It's designed to extract wealth from them. But here's the good news. Once you understand how the game is played, you can protect yourself. You can build wealth even in a rigged system. You just need to be smart, disciplined, and informed. That's what this channel is about. Giving you the knowledge to navigate this system and build financial security. If you learned something today, hit that like button. Subscribe for more deep dives into finance and economics. Thanks for watching. I'll see you in the next one.